I'm Steve. Today, we're digging into one of the most powerful tools in a trader's arsenal, Bollinger Bands. We're going to break down what they are, how they work, and most importantly, how you can use them to get a read on the market's next big move. Let's get right into it.
To really get a handle on Bollinger Bands, let's start with a really simple analogy. Think of the market as a highway. If that's the case, then these bands, well, they're the guardrails. They're what keep everything in check. Most of the time, the price is like a car, just cruising predictably right down the middle of the lane. But you know how markets are. Sometimes they get a little erratic. The price swerves and it heads for the edge of the road. Those Bollinger Bands act as the guardrails, telling us, hey, the price has probably gone too far and it's due to come back toward the center.
And that right there is the whole ballgame for us as traders. Knowing where those edges of the road are, that can mean the difference between a fantastic trade and getting in at the absolute top of a move. It's all about spotting the market's extremes.
So how do these guardrails actually work? Well, it's not magic, it's just math. And it all boils down to something called the 95% rule.
Now, when you first pull this indicator up on your chart, it looks pretty simple. It's just three lines that kind of breathe with the market, expanding and contracting. But it's the relationship between these three lines that holds all the predictive power.
Let's break them down. That line in the middle, that's your foundation. It's a simple 20-period moving average. Think of it as home base, or the median lane on our highway. Then you've got the outer lines, the upper and lower bands. These are the critical guardrails, and they're plotted 2 standard deviations away from that metal line. And standard deviation is really just a fancy way of measuring how spread out the prices are from their average.
And this brings us to the statistical core of this whole tool. Here it is. Mathematically, the price of whatever you're trading is going to stay inside these 2 outer bands about 95% of the time. That's not my opinion. That's just statistical probability.
So what does it mean when the price actually gets out there and touches one of those outer bands? It means the price is overstretched. It's like a rubber band that's been pulled way too tight. And statistically speaking, it's way more likely to snap back toward the middle than it is to stretch any further.
Let's make this real. Imagine you're watching the micro S&P, the /MES, and it's in a strong uptrend. Let's say it's trading at 6,914, and the price finally pushes up and just tags that upper Bollinger Band. Now, this doesn't mean you have to sell that exact second, but it's a huge signal that the buying momentum might be totally exhausted. The odds have shifted. The easy money on that move is probably over.
Okay, so beyond just spotting overstretched prices, the bands can signal something else. Something that honestly I find even more powerful. It's a pattern called the squeeze. And it's like watching the market take a deep, deep breath right before a massive move.
You can see a squeeze forming right on your chart. The upper and lower bands, they start to pinch together, getting narrower and narrower. What this tells you is that volatility is just drying up. The market is getting quiet, too quiet.
But listen, don't ever let that silence fool you. Quiet markets always lead to loud markets. In the futures market especially, a squeeze is almost always the calm before the storm. The market is coiling up like a spring, just waiting to explode.
And here's the kicker. The longer that squeeze lasts, the more time the bands spend pinched together, the more violent that eventual breakout is going to be. When you finally see those bands start to flare open, like the bell of a trumpet, you know the big move is on.
Now, before we wrap this up, I have to give you a serious word of caution. This is especially for beginners. There's a really common mistake that can cost you a ton of money if you're not ready for it. It's a phenomenon we call walking the bands.
So, you might be asking yourself, okay, Steve, if the price hits the top band and it's overstretched, doesn't it have to reverse and come down right away? And the answer to that, unfortunately, is a hard no. See, here's the critical difference. In a normal market, sure, price touches an outer band and reverses back toward the middle. But in a really powerful, sustained trend, something else can happen. The price can stay glued, absolutely glued, to that outer band and just keep on climbing, or falling. That's what we mean by walking the band. This is the trap. This is where so many new traders get wiped out. They see the price hit the top and they think it has to come down now. So they try to short it. They try to fight a freight train of a trend. And that is a fantastic way to lose a lot of money really fast.
So what's the solution? It's simple. You wait for confirmation. We don't trade just because price touches the band. We wait for the price to actually move back inside the bands. Even better, wait for a candle to close back inside the band. That's our signal. That tells us the stretch is officially over and a reversal is now much more likely.
All right, let's bring it all home. What are the key things you need to walk away with so you can use Bollinger Bands in your own trading?
First, use the bands to see the breathe of the market, that natural expansion and contraction of volatility. Think of the lower band as potential support and the upper band as potential resistance. A classic strategy is looking for buys near the bottom and sells near the top. But always wait for that confirmation. And when you see that squeeze forming, honestly, it's often best to just stand aside and wait for the breakout.
At the end of the day, these bands give you a dynamic map of the market's volatility. Use them to understand where the extremes are, but never ever follow them blindly. I'm Steve. Respect the guardrails.